My name is Anthony Wilson with ShareVault. ShareVault's industry-leading virtual data room technology puts your deal on the fast track by giving you the tools to share your confidential data with people you need to trust today but don't know if you can trust tomorrow. The purpose of today's webinar is to give CEOs, CFOs, and other C-suite executives who may be new to fundraising a fast track to the first capital raise. So I'm excited to announce today's speakers. We have Kim Arnone, who is a managing partner at Cutting Edge Capital, and Jonny Price, who's a VP of fundraising at Wefunder. So Kim and Jonny, thank you for joining us today. And with that, I'll toss it over to Kim.
Great. Thank you, Anthony. Super excited to be here. A little bit about me. I've got 25 plus years of experience as an attorney, and I'm a big firm escapee, and now managing a small boutique securities firm with a couple of partners. We specialize in helping folks strategize and structure capital raises, especially if they're looking to reach out to their community of supporters, fans, just general folks who they would like to be able to turn those folks into investors. And typically that requires securities strategy that allows everybody to know about your raise. So it has to be public, and then also to be able to reach and allow investors of multiple wealth levels to invest. So that's our expertise. Let me turn it over to Jonny.
Yeah, hi everyone. Jonny Price here. I'm the VP of fundraising at Wefunder. Wefunder is an investment crowdfunding platform with the largest regulation crowdfunding platform in the country. And we help startup founders raise capital using these exemptions that we're talking about today, using regulation crowdfunding, using regulation A+. So if you're a startup founder raising capital, which it seems like a lot of you guys are, then hopefully this will be a really interesting discussion about how to use these new laws, as an option to consider in raising capital. We're a two-sided marketplace, so as well as helping founders raise capital, our mission, we're a public benefit corporation. Our mission is also to democratize angel investing. So rather than angel investing being the preserve of, 5% of millionaires in America, what if we could turn millions of ordinary citizens into angel investors investing in startups they love or small businesses in their communities? So that's what we're about at Wefunder. And yeah, looking forward to diving in a little deeper over the coming hour here.
So today we're going to, as Jonny said, Regulation Crowdfund and Regulation A are our topics. We want to be able to let you guys know what to expect if you're looking at one of these options to see if it's a good fit, what some of the requirements are. I think you'll be able to take away the slides. There's a lot of detail, especially from the regulatory standpoint as to what's needed. We're not going to dive too deep into the weeds on that, but we wanted you to be able to take something away that you can refer back to. And ideally, we'd like to get you to a point where you feel like you can set yourself up to succeed if one of these options is right for your company. Great. So we're going to start with Regulation Crowdfund, Reg CF. And I often talk about Reg CF as being a community capital offering. And generally, what I mean by that is a very broad offering. And for it to be broad and to reach a large community, it has to be public. And Reg CF ticks those boxes. It allows, again, as Jonny was saying, not just the wealthiest to invest in startup and growth companies, but also regular folks who have some investable income and would like to invest in your private company. So before we jump into how Reg CF works, I wanted to sort of lay the foundation that this strategy allows for multiple types of offerings. So what we see a lot is preferred stock from corporations, less often common stock. And then there are a number of convertible type of securities that can be used, convertible notes and safes, which are simple agreements for future equity. Convertible notes and safes, just for some background, those are typically used when an enterprise is expecting to have a next round, which triggers those securities conversion into stock. We're also seeing the use of what's called revenue share notes a lot more, which are notes that are payment dependent on what the revenue of the organization is. So the faster the revenue goes up in that organization, the quicker those folks get paid back. But there's not necessarily a set term for payback or a set interest. That can be really interesting and helpful for some smaller organizations who don't mind having debt on their balance sheet, but want a little leeway if they're ramping up to revenue, because it gives them a little bit of time before there's a big, the payout starts. And then less often I see term notes, but I did want Jonny to weigh in too, and tell us a little bit of what you see on Wefunder, what investors you think investors are looking for and why with the type of securities.
Yeah, absolutely. Wefunder has had companies raise capital using all of the securities that are listed on the slide here and others as well. Generally, our approach is to say, okay, if you're a startup founder raising capital, if Wefunder didn't exist, if regulation crowdfunding didn't exist, how would you be raising capital? So if you were doing Regulation D and you were going to VCs or institutional investors, family offices, or angel investors, would you be doing a SAFE or a price round, or maybe a revenue share or a loan? And so in conversations with the investors that are going to come in and anchor the round, try to align on the terms. And then once you've hammered out those terms, then put those terms up on the crowdfunding platform so that you can raise on the platform. And for me, like we kind of have that framework with a lot of this stuff is, again, in a world of Regulation D, what would you do? And just to articulate the difference between, how most startups raise capital through Regulation D, and then what we're talking about today with crowdfunding, the two main differences I cite, and I don't know if there's others you would highlight, Kim, but, firstly, rather than just being restricted to raising capital from accredited investors and, institutional investors, which is how most startups raise capital through Regulation D today, with Regulation Crowdfunding or Regulation A+, you can now raise capital from everyone, from unaccredited investors as well as accredited investors, from your customers, from your friends and family, from your community. And so the number of people that you can raise capital from goes from kind of 5% of the population, wealthy people, millionaires, to everyone. And then the second big difference versus most kind of Regulation D raises is that you can publicly promote and market the fundraise. And so you can put it out on social media, you can send an email blast, you can put out a press release. So for me, at a high level, like regulation crowdfunding versus, Regulation D, I don't know if we'll get into 506B versus 506C, but those are the two big kind of really exciting things for me about Reg CF or Reg A. Now you can raise from everyone, you can let your customers and community invest, and also you can publicly promote it versus, privately soliciting investors behind closed doors.
Great. So a little background on Regulation Crowdfund. It used to be that almost all private companies, their only option really was to do a private raise, the Reg D type private raise. Regulation Crowdfund came about as part of an act that was designed to help the US economy and in particular smaller businesses. And so it has some limitations. It's been in use for 7 years, and we've seen a lot of changes. It's an exemption, which means you don't have to file the types of information disclosures that are required by those kinds of businesses that are ready for an IPO and have continual filings. It's a much leaner approach. One of the safeguards that was put in place for Regulation Crowdfund, because it was one of the first to open up to non-accredited investors, and there's definitely a consumer protection component to this law. And the safeguard they put in was that if you are going to use this exemption and not have to do the onerous disclosures of a full registration, then you must list on a registered Regulation Crowdfund portal. And that's what Wefunder is. And again, it has evolved over time. I do know, Jonny, that so one of my former colleagues at Cutting Edge helped write some of the initial draft regulations on this. And then I know Wefunder jumped in and really pushed and educated lawmakers to get this law enacted, and was already ready to take it to the next level once it became effective. Do you have any other background on that? I think it's a really interesting approach.
Yeah, absolutely. Our founders were very early. In 2012, actually, the start of Wefunder was a petition to enable everyone, not just rich people, to invest in startups. Our co-founders were in Boston at the time, and they were frustrated because they were serial entrepreneurs and they had all these smart friends. One of our co-founders went to MIT. He had a bunch of smart friends that were starting companies. And because he wasn't yet accredited, he wasn't able to invest in those companies. And they said, this is very unfair. This is very un-American. I can invest in public companies on the stock market, but I can't invest in my friends' startups. I can go to Las Vegas and spend, $10,000 on the spin of a roulette wheel, but I can't invest $10,000 in my neighborhood coffee shop. So they said, this is insane. And the Jobs Act came out of, it was in 2012 that the act passed Congress. So it was coming out of 2008 and the great financial crisis. And so, liquidity was, there was less capital available for entrepreneurs to raise capital. And I think that was part of the impetus for this bill, was to unlock kind of more retail investors' capital to invest in early stage companies. And so, the start of Wefunder was a petition that was, and part of, ended up in one contributor to the Jobs Act that passed Congress in 2012. And then it took the SEC 4 years to roll out the regulations, which they did in May 2016. But coming out the gate, I think Wefunder's been the largest platform every year since then.
So a little overview of Reg CF. In my opinion, it's the easiest way to get a public national offering out, and it's quick because the materials, and we'll get deeper into the materials on a later slide, but it's more expedient to put them together. It doesn't take as big of a lift as, for example, a full-on offering memorandum, and it's quicker to launch. And Jonny, do you have some estimates and sort of averages for what you see for launch time for most companies?
I would say that there's kind of two versions of launching a regulation crowdfunding campaign. As you know, Kim, Regulation A+, and we'll talk a little about that later as well, but Regulation A+, you can raise up to 75 million, so you can raise a lot more capital, but it's a lot more work. You'll pay Kim a lot more money, and she'll be well worth it, and it's great value for money because she'll do a lot of work. But there's a lot more kind of legal work and kind of financial audit work, both upfront, and you need to get SEC approval for Reg A+, then also ongoing in terms of ongoing reporting requirements. So Reg A+ is a different animal. That will take many, many months to get approval and launch. But regulation crowdfunding is a lot simpler, smaller. You're capped at $5 million per year in what you can raise through regulation crowdfunding. But it then is a lot easier to raise. And there are kind of two pathways for launching regulation crowdfunding. We call it Reg CF. Two pathways for launching a Reg CF campaign. One is that, first of all, you do the legal paperwork. It's called filing a Form C with the SEC, a Form C. And so before you can close on any money through Reg CF, before you can get your hands on the money, you need to file this Form C. And so there's one path where you file the Form C first. Typically, that might take a month. And usually the long pole in the tent in that month, the most work ahead of time is getting a CPA to sign off on your financials. And then if you're raising more than $124,000, you need a CPA to do a review of your financials. If you're raising more than 1.235 million, you need a CPA to do an audit of your financials. And so especially if you do an audit, that's quite a lot of work. It will cost you some money that you pay to the CPA to get that audit done. And so those financials, and then you're putting together the profile page. There are some legal disclosures that you need to fill out, go into the Form C filing. Maybe you need a lawyer to draft a custom investment contract if you're doing a price round. If you're doing a SAFE or a convertible note or one of the standard template contracts we have, you can use an off-the-shelf contract and save yourself some time there. But if you're doing a price round, you would want Kim or a lawyer to draft a subscription agreement. That will take some time. So there are a few different elements that go into filing a Form C. Like I say, normally, if you want to move quick, you can turn it around in a month or so and then start raising. The second path is that you utilize a relatively new part of the law, which is called testing the waters. This was passed by the SEC in March of 2021, so it's only 2.5 years old. But through testing the waters, companies can start sharing about their intentions to raise capital before they file the Form C. And you can't close on the money yet, but you can start sharing it with your network and start actually collecting reservations. And with testing the waters, you can spin up a testing the waters page on Wefunder in 30 minutes. So, you just kind of get the page looking like something you're happy with. We have a button where you can upload a pitch deck. You don't even need a video. If you don't want, you can just put a photo in. You can, if we're doing a SAFE with an $8 million valuation cap and a 20% discount, you can just kind of click that. And so I've launched companies in testing orders in 30 minutes. So that can be a much faster way to get going. Although again, before you close on the money and before those reservations are firmed up to investments, you need to file that Form C paperwork with the SEC. And again, that process will take a month. So typically it might take a couple of months to get your hands on the money. But through testing orders, if you really want to move quick, let's say you have a big marketing opportunity, you're speaking at a conference like tomorrow, through testing orders, if you want to, you can spin up a page and have that live, and you're able to start sharing that, very quickly.
Great, thanks. You've gone through it at a high level, some of the things that are on some of the rest of the slides. This is the very specifics.
Sorry, Kim, I'm
No.
jumping the gun here and stealing the
It's
thunder.
good. It's good. And we can dive in a little bit more. So this sort of lays out the types of financial statements you'll need for reg crowdfunding. So if it's a small raise, 124 under or under 124, then you just need your financials certified by your CEO. And then if it's your first time doing a reg CF, if you have your financials reviewed by an outside accountant, it gets you up to a 1.235 as a top raise limit. And if you audit your financials, it's 5 million. I have had clients, and I'm sure Jonny has seen this many times, that they do serial reg CF raises. So if you come back for a second reg CF raise, one of the things that happens is that you can only raise up to 618K with reviewed financials. You need to bump it up to audited the second time if you want to get up to 1 million again, or up to 5 million in this case. So those numbers will be there for your reference. We can go to the next. Great. The other kind of limits are limits on what your investors can invest. And so accredited investors, which we've been throwing that term around, but what that means is generally for people, accredited investors are those who have $1 million in assets, excluding their home, cars, and furnishings, or they have $200,000 in income the last 2 years and expect that in the current year, or $300,000 as a household. So that is very limiting. And so in order to get folks who have it, there are a lot of folks with investable income who don't meet those accredited investor limits. So reg crowdfunding allows them to take that investable income and invest it. And there are a couple of suitability requirements for non-accredited investors. So if they have income or net worth less than 124, they're limited to 2,500 or 5%. And then if they're over 124 in income or net worth, then they're limited to 10% of their income, annual income or net worth. So those investors have to certify that they meet those requirements. So it's not on the issuer to dive into their finances and figure that out. They attest that they have met those limits. And so that kind of can give you a sense of what the range you might be able to expect from accredited and non-accredited investors. But typically we don't see a lot of issues with that. Does Wefunder, Jonny, track if someone's a serial investor on Wefunder? Does it track how much they've invested and whether they might be at that 5% or 10% limit?
Of course we do, Kim. Of course.
Great. So they help you out there on that point as well. Next. So I think about the disclosures that are required for regulation crowdfunding in 3 different silos. First, it's not a lift like a offering memorandum is a lift, but the sort of legal and business disclosures do kind of cover some of the same topics that you would find in a private placement memorandum. And they include who are your management, who owns the company, who controls the company, what does your cap table look like? Have you done other raises before, whether they be friends and family or a private raise with accredited investors? How do you plan to use the money? What's the financial state of your company, right? And then we talk a little bit about how the security will work. So if it's equity, we talk about what the rights and privileges of that particular class of equity are, and we draft the investment agreement to explain all of that. We also, if it's a note or some sort of convertible security, then we talk about what triggers that conversion or what the interest or payback schedule might be. And then we do, everyone wants to disclose what the material risks are for an investment. It protects the issuer. It can be a scary thing to do because, everybody's like, well, if I tell everybody what the risks are, will they really invest? And yes, they will really invest, and it really is protective of you. But that silo are all of those disclosures. They're the kind of boring things that I help with. And then there are the financial disclosures that we talked about, whether it's reviewed or audited, that an outside accounting person or your internal accounting person helps with. And then there's the fun stuff, which is really the pitch material. And that's really where Wefunder can be very supportive, both with ideas, but also with a great template. I mean, I sometimes describe Wefunder to some of my clients who are considering Reg CF as a really great tech company, because they've designed these interfaces to allow you to do both the business and legal disclosures, but then also to craft a pitch. So, Jonny, I'd love for you to tell folks what they can do and what you've seen that's worked really well, that's made a compelling kind of pitch, and how that integrates with Wefunder's platform.
Yeah, I mean, again, kind of going back to what I said on the investment contracts and the terms, I generally recommend, like, imagine Wefunder didn't exist and you're kind of pitching VCs or angel investors. What does your pitch deck look like? Problem, solution, traction, TAM, team, that kind of things, use of funds, and just kind of copying that playbook. There's definitely some elements to which there's some nuance for the fact that this is, for a larger audience, your customer base, a retail audience. And so maybe a little bit more emphasis on like the storytelling and the narrative. There's a place for a video, right? So you can get 1,000 Bibles on a video of you pitching the company, which is awesome kind of brand awareness, right? As well as kind of the opportunity to raise capital. You can put in, photography and assets that you can, there's a header video up front, but then there's also places where you can put videos throughout the kind of story section, where maybe that's like a customer testimonial or an existing investor talking about why they invested and the vision that they have, or maybe it's kind of a product demo. So yeah, one thing I say this about like the pitch, but also about like the marketing of like how you run one of these campaigns is I talk about kind of zone of genius, or your kind of superpowers as a company, right? So in the pitch, if the best thing about your company is your month-over-month growth rate, then you kind of lead with that, right? If the best thing about your company is that you just graduated from Y Combinator, then maybe you lead with that. If the best thing about your company is like you're a team of like, scientists with like 10 years of experience working, as a PhD in MIT, then maybe you lead with that. So it's kind of, what are the best elements of your company or you as a founder, and your story, your narrative, your pitch, and really kind of emphasizing leading with that. And there's a lot of opportunities to really kind of promote those, most exciting things that are really going to grab investors' attention. You can do it in the video, you can do it in the photo, you can do it in the highlights, you can do it in the story section, you can do it in the team bios. But that's kind of one kind of meta, I guess, piece of advice on pitching. That's probably whether on Wefunder or whether you're doing regulation crowdfunding or raising capital more conventionally.
Great, thanks. So not to get too deep in the weeds, but one of the reasons why I like to talk a little bit about the advertising rules with Regulation CF is if you're trying to envision how you might build a campaign, it's good to sort of know what you can and can't do. Regulation crowdfunding, like I said, there are some sort of consumer investor protections sort of built in. So the platform is one, but the advertising rules are another. The idea is that everyone who's thinking about investing in a company listed on a Reg CF portal has access to the same information. So the idea is you can promote that you're doing and offering, but you need to include the link back to your profile page, which has all the links to all the disclosures. It has your pitch. It has a way to do questions and answers, but linking back to that vibrant space ensures that everybody has access when they're making their decision to invest. And that's sort of one of the backbone pieces to this regulation and keeping it fair. Next. So this is, as Jonny said, too in the weeds, but I want you to have this information that so you kind of can limit what you do as long as you're linking back, and you can do enough to get people interested in clicking the link. But in doing this, and it's designed, you could really design this for social media, for something that you include in whatever your communications are to your network, whether that's some sort of newsletter or other type of outreach. It's real simple to put that link in and come back. And as long as you kind of keep within the rules, then you're fine. The idea is just not to put out information to certain people and not have it be included in what's part of your package on the website. So we've touched on this already. Testing the Waters also has additional advertising rules. So you can't accept any money during testing the waters period, and you have to there's a specific disclaimer that needs to be included in it, but that's the only additional overlay when you're in that phase of just accepting indications of interest, right? Or reservations. So you just need to, as you're pushing that out to your network, be clear that there's an additional little legal blurb that you have to put on. The lawyers, they get involved in everything and make it harder. Next. So this is a good place to showcase Jonny's depth of knowledge with what he's seen on Wefunder. And again, Wefunder's the biggest RegCF platform out there, and they've been doing this since before RegCF was even out there and able to use. So they've been thinking about this for a long time, and they have a big track record. And we've worked on a number of campaigns together, but I'd love to hear what you think about where does a business need to be with its network in order to make good use of RegCF and your platform?
Yeah, that's a good question. My answer might surprise you, Kim, but I would say like RegCF can be a valuable tool for a very wide array of companies and founders, entrepreneurs. I think like the stereotype, right, is like a B2C company with a huge audience. And definitely that's a sweet spot, right? So some of the most explosive Wefunder raises, we call it community rounds. We think that's a really nice way of talking about this. You do a friends and family round, you do an angel round, you do a community round where you let your community invest in your company. And some of the best community rounds, you think of a company like Substack, the newsletter platform. They raised $5 million on Wefunder in April of this year. And they raised $5 million in a day. They maxed out the $5 million, regulation crowdfunding limit in 24 hours, less than, because they have millions of writers on the platform and readers who love the product, love the platform. And when they said, hey, would you guys like to invest in Substack? 5,000 people said, sure, where do I send the check? And so wefunder.com/Substack is the URL if you want to check it out. That is definitely the sweet spot, right? Consumer facing company, huge audience, fans that love them. That's the sweet spot. But for me, if you're a early stage biotech company and you want to raise like 100K, and you might be doing a friends and family round, this is a great way for you to run a friends and family round. I say I don't really understand why anyone would run a friends and family round without doing it on a platform like Wefunder. And there are other ones as well, by the way. They're just not as good. Just kidding. Great shout out to Wefunder competitors. But if you're doing a friends and family round, doing it through a regulation crowdfunding platform allows you to, with no worry about accreditation, raise from unaccredited investors as well as accredited investors. 50% of investment volume on Wefunder is from accredited investors. So a lot of the money is still coming from accredited investors. But now you can also raise from unaccredited investors. You can publicly promote it. We have a really nice, as Kim mentioned, we're a technology company. We have a beautiful kind of infrastructure where you can just like send people a link and they can go through and invest, and we handle the payment processing. We hold the money in escrow and then send it to you. We have them sign the investment contract, so everyone's signing the same thing. We create a special purpose vehicle, an SPV, to roll all those investors up to one line on your cap table, so you don't have dozens and dozens of lines on your cap table, which can cause kind of complications and challenges if you're raising from VCs down the line. So and also you get in front of Wefunder investors as well. That's usually a small percentage of the raise, maybe 20-30% of the raise, but that's free money that you otherwise wouldn't get if you were not using a platform. So you put all those things together. I think this is a very, very valuable tool for a company that's raising a small amount of money using a friends and family round, as well as for Substack they just did a Series B. For Mercury Bank it was a $5 million raise as part of a $120 million Series B. So it can be for much larger companies, but it can also be for early stage companies. And biotech founders have used Wefunder. They don't have customers yet. They don't have a community, but or or at least in the sense of customers. But maybe the founder has other scientists that they know that are interested in what they're working on and can invest. But so it's really eclectic. And in terms of industry sectors as well, me and Kim have worked on a couple of soccer clubs together, which has been fun. We've had movies raise capital on Wefunder. We've had healthcare and biotech companies. We've had B2B SaaS companies. We've had consumer-facing companies. So yeah, only US companies would be one thing. And then the amount of capital that you're raising is a factor as well. So Wefunder can do 50K. That's the minimum that we allow, up to 5 million. Even if you're looking at raising 25 million Series A, it could be that the Wefunder community round is a part of a larger round, right? So Replit's another example of that. Wefunder.com/Replit, REPLIT. They raised an 80 million Series B and then opened up a $5 million allocation to let their customers invest. So yeah, I honestly have, there are pretty few kind of disqualifying criteria, I would say, in terms of, the types of issuers best suited, the types of companies best suited to raising capital in this way. I would say one principle would be, are you not just comfortable with, but also genuinely excited about raising capital in a kind of a public way and in a marketing oriented way, right? Are you excited about the idea of bringing in hundreds of people, potentially thousands of people, to invest in your startup? And for some people that's sounds like a nightmare. So I think the best founders, or the best fit for regulation crowdfunding, are founders for whom, okay, if I can recruit hundreds of people, that's going to be my marketing team. They're going to be loyal customers. Maybe they can help me with recruiting or product feedback. And I'm really excited about kind of building this army, strengthening community, and then I've got hundreds of investors that I can put to work to help me grow the company. That for me is maybe one thing in terms of which types of entrepreneurs and founders are going to really both succeed in raising capital in this way, but also then kind of get the most out of this community source capital in the months and years ahead.
Great. This is pretty much our last slide for the Reg CF. So there were a couple things I don't think we got to, but one of the questions I get a lot from clients is, well, how much is it going to cost? And so typically where you see the fees are, one, if you're going to need an outside accountant to do a review or audit, and then depending on how complicated your raises, whether or not it's something that can be more formulaic like a SAFE or a revenue share note, or if it's something that requires a bespoke kind of investor contract like equity, then you'll have more attorney hours depending on how you approach that. And then Wefunder has sort of a flat fee approach, and it's what my clients find helpful is that it's a back end only payment. So there's no upfront costs. So the upfront costs are really limited to accounting and legal. And then again, one of the things that my clients consider from the cost perspective is that they don't have to set up a payment processing. They don't have to build a whole nother section of their website to showcase what they're offering. That's all done as part of this fee. So I don't know if you want to touch on that anymore, Jonny.
I don't think so. We covered that.
Okay. Yeah. So that's kind of the big picture of that. We're going to shift gears and talk a little bit about Reg A. I do think that as folks are sort of just building up through raising capital, Reg A is sort of the far off possibility. We wanted to touch on it today because, like Reg CF, it is a nationwide approach to raising capital from both accredited and non-accredited investors simultaneously. It is a much bigger lift from a disclosure perspective and an attorney time perspective, and then also ongoing costs for continued submissions to the Securities and Exchange Commission. So the kinds of disclosures that are needed, there is very heavy regulations on what needs to be covered, and it is similar to what people put together for an IPO. It's not as heavy, but still a lot. And the SEC, unlike Reg CF, once you submit your disclosures, and the disclosures, you have requirements of what you need to submit, but it gets filed on Edgar and goes to the SEC, but they don't push pause on your raise and then review it. It is exempt. So the filing, it becomes a public filing. With Regulation A, it's different. You submit your filing again on EDGAR to the SEC, and the SEC spends a fair amount of time processing it through, and they call it, when they issue their decision, it's called qualification. And so that is the process. And it's very hard to time. I've had one client be live in a month and another was more like 9 months, lots of back and forth. And it was sort of hard to peg when they were going to get to start their raise. But again, this is an approach that should be a long-term, long-planned approach. And it's designed not to be sort of triggered as quickly as a Reg CF. Next. So Reg CF is broken up into tier 1 and tier 2. Tier 1 has a $20 million raise limit and tier 2 is $75 million. The differences are the tier 2 is a nationwide approach to raising capital. Tier 1, you do your qualification with the SEC, but then you have to look to each state's regulations and get their regulators to approve it as well. The tier 2 does not allow the states to weigh in on the securities part, only in tier 1. And it's so onerous to do a state by state. So if you say, well, I'm really only going to have folks from 2 or 3 states, getting it registered in 2 or 3 states after you've already done a major submission to the SEC is expensive. And what it saves you is a little bit of ongoing reporting, but I don't see anybody choosing tier 1 very rarely because the cost of dealing with every state and the regulations being different across states, it is not useful. Clients of mine that have chosen Reg A are some of them are under 20 million and they still choose to do tier 2 because it is more straightforward and it, believe it or not, less time. So next, please. So we touched on this. Testing the waters was allowed in Reg A from the beginning, and that's something that Reg CF has also adopted as it evolved. But again, it has rules on what you have to say. Reg A, the testing the waters for Reg A, I think is very useful because it's such a heavy expense and regulatory burden. Seeing if there is interest is a key component to deciding whether or not a company wants to use Reg A. And if you do choose to test the waters and you find out that like most of the interest came from 5 different states, you can't then shift gears and do a tier 1. So that the catch with doing a testing the waters is that if you continue, it has to be a tier 2 offering. Next. So again, Reg A is open broadly. It does have suitability requirements for non-accredited investors. They're different than Reg CF and they're here so you can refer back to them as you need. One of the other difficult things about using tier 1 is that the investor limitations differ from state to state, and the states get to decide what those suitability requirements are. So it's a lot more for the company to track. So the disclosures are much more like an offering memorandum. They're even more detailed than most private placement memorandums. And if you use a tier 2, you've got to have audited financial statements, and you do have to continue to provide semi-annual reports and material reports if there are changes. And then you eventually can file a closing report and stop the reporting. But it is also a big lift internally for your finance folks to keep on top of. We touched on that. I'm ahead of myself. So ongoing reports. So really, this is really for folks that have done a fair amount of capital raising already and feel ready to embrace the kinds of marketing that you would need to do to have a raise that you're aiming for, the 50 to 75 million range, if that's where you're going with it. A lot of folks who are looking at Reg A are also using it as a way to get out enough of their securities, their equity securities, in order to qualify to do some trading on the over-the-counter markets if they're not ready to be listed on a bigger market. So it is a tool for that. But for most folks, especially given the poll, this would be something that would be way down the line. But it is something to consider, especially if you can galvanize that some sort of identifiable group of folks that you can get in front of, and that they would be interested in the problems that you're solving, the product that you're making, the services you're providing, whatever is the crux of your business, being able to get excited about it and see a future, see a potential return. So this is just sort of the summary. Again, we've touched on all of these, lots of filings, lots of ongoing financial reporting, and hard to time offering. So those are a lot of negatives. There are positives, but you really do need to bring in your advisors, including legal advisors, before you make a decision to jump in. And quite frankly, to be preparing for it for a long time before you're ready to pull the trigger. It's a big decision. It's a useful tool, but it doesn't occupy the same space as Reg CF, which is more useful, easier to implement than other types of public, non-accredited focus raises. All right, that brings us to Q&A. I know we've been answering some as we go along.
Yeah, you guys have been doing a great job of answering the questions as they've been popping up. We have a couple more. The question is, do I need a Big Four audit, or will any CPA do? Does it matter?
And any CPA will do. You don't need a Big Four audit. In fact, I mean, yeah, I'll just leave it at that. We normally recommend saving some money on that.
Okay. The next question is, you talked a lot about investor limits. Is there a limit on total investors?
The number of investors, no, there's no limit. The dollar amount you can raise, yeah, that's where $5 million is the limit. If you have a CPA audit, if you have a CPA review, it's 1.235 million. If you don't have a CPA review, it's just self-reported financials, and the limit is 124,000. But you can have as many investors as you want. And yeah, the individual investor limit is based on the formula that Kim mentioned. If you're an accredited investor, then there's no limit on what you can invest in Reg CF deals.
So, and to add to that, there are number of investors for triggering reporting company status with the SEC. So what's nice about Reg CF is that the Reg CF investors don't count against the upper limit of number of investors before you start to trigger those reporting requirements.
If they're rolled up to an SPV or a custodian, right?
It doesn't, I don't think it's required, but as long as they came in through a Reg CF. But there's also an asset limit, and what Reg CF, that it's called, not to get into the weeds, but I can't help it, I'm a lawyer. The triggering 12G, which is the reporting requirements regulation, it depends on, outside of Reg CF, if you have 500 non-accredited investors or more than 2,000 any investors, and have a certain asset limit at 10 million, then you have to do reporting to the SEC because you have enough investors, even though you're not publicly traded or you haven't filed a registration. And Reg CF has it raises the asset limit to 25 million, but it also excludes the Reg CF investors as part of that count. Okay, so technically there are limits, but.
So you mentioned testing the waters. Could you provide a little bit more detail on that? How do I do that? How do I test the waters?
Yeah, so I can speak to that one. So testing orders is basically where you are sharing with investors about the fact that you're raising capital before you have filed the legal paperwork with the SEC, which is called a Form C. So once you've filed the Form C, you're no longer in testing waters mode. I call it in the waters mode, but that's kind of questionable, and everyone on my team objects to that rather spurious pun. But so testing orders before you file the Form C, and you can be in testing orders, for months and months if you want to. Any investments that you raise in testing orders are technically not investments; they are reservations to invest. And then when you file the Form C, you email those people and hopefully convert them from reservations to investors. The way that you launch on testing orders, you go to wefunder.com/raise, or I actually think Wefunder, I don't know if you know this, Kim, but I think Wefunder might be maybe the only platform, or certainly one of the few, that kind of encourages and has the infrastructure to allow companies to raise in testing orders. Certainly, I think we've leaned a lot more into that than some of our competitors. But yeah, if you want to explore Wefunder as an option for raising testing orders, go to wefunder.com/raise, or go to the website and you can easily see, okay, raise capital, and then you can go through the flow and spin up a page that you can start sharing with potential investors. Like I say, you can be live in testing orders very quickly and easily, if you want to move quick. But also, obviously, most folks are kind of reaching out to us, and we're kind of chatting to them about expectations and kind of the process, so that they're not just kind of entirely self-serve and figuring it out themselves. Like, my team's job at Wefunder is to help founders who are considering raising capital in this way, help them understand the pros and cons, the process, etc. But yeah, wefunder.com/raise if you want to learn more and even, start an application and explore that.
Great. Thanks for clarifying that. Next question is, were there additional reporting requirements for a raise under 124K?
So the difference with the reporting requirements is that under 124K, you don't need an external CPA, an accountant, to conduct a review. And that will both take some time to get the accountant the information they need, and it will also cost some money. CPA review typically ranges from $2,000 to $7,000 is what I've seen, depending on the complexity of the financials of the business. So if you're raising less than 124K, you don't need the CPA review. You do still need financials that you are going to share. And there's a bunch of legal disclosures in the Form C filing. So for example, who are the owners and officers of the business? What date was the company incorporated or registered? Talking about the capital that you've raised previously, disclosing risks to investors, the investment contract, a description of the financials of the company that's raising capital, et cetera, et cetera. We have a kind of a TurboTax style software where you can kind of go through and enter that information. We think we make it as easy as possible to fill out a government form. But yeah, there's still some other disclosures that you need, even if you're capping the raise at 124K. It's just in that case, you don't need a CPA to review or audit your financials.
Next question. We use other formats for qualified client and qualified purchasers. Can you compare that with Reg D qualification? And because we are focused on fatter cats at 2.1 million and 5 million thresholds of risk funds the investor has, can you describe the ease or difficulty of process?
You want to speak to that, Kim?
Well, I hope I understand your question, but for Reg D, it's accredited investors, right? So it's primarily accredited investors, and accredited investors have to have at least $1 million in assets, or they meet that 200K or 300K annual income. It's either or. So there are a couple of ways you can verify if people meet those types of limits in the US. So if there is a way to do a public private offering called a Reg D 506C offering. In that, you have to actually have a third party verify that someone is accredited. But in a private raise, a 506B raise, you can just have the investor attest that they are in fact accredited. They know what the limits are and they are accredited. So that process, if you're asking about that kind of larger investment process, typically that is done under Reg D and not Reg CF if at the levels that individual levels you're seeking investment. And the ease of the process, it is not a heavily regulated process. Regulation D offerings are exempt and they don't have specific offering requirements. But what you typically see is a full-blown private placement memorandum at the amounts that you're looking at. It does not have to be filed with the SEC, and it doesn't kick into the ongoing reporting requirements. So there is an ease there. But again, investors at that level are going to expect very sophisticated disclosures. So right. I hope I answered your question.
So we have, and I know we're at the top of the hour, we have 2 more questions. I see, Jonny, you're typing the answer to the second to the last one. I'll just ask the last one live. How long does the raising company need to be incorporated in US before being allowed to crowdfund?
There's no requirement, so you can be a total startup. In fact, in testing the waters, you can even start raising money before you've incorporated. It just needs to be that before you file the Form C, you need to have incorporated the company, and you can incorporate as a C Corp or you can register as an LLC. S Corps tend to be less compatible with Reg CF. But yeah, C Corps and LLCs. We've actually done a raise for a nonprofit that did a debt offering. Yeah, but vast majority are kind of either C Corps or LLCs. But yeah, even in testing waters, you can even start fundraising while you register or before you register.
Right. And we had a question earlier about a Canadian company doing this. And we have had clients who want to access the market and have enough connections to the US that they set up a parent company who then a subsidiary is a foreign entity. And if there's a US parent company, you can utilize Reg CF because that company is a US company. So it's more detailed than that, but there's a possibility, and we've done that and are doing that right now with one client on Wefunder.
Okay, great. Thanks. If you wouldn't mind, Kim, taking a look at this question. It was about
Yeah. We don't use the terms qualified clients and qualified purchasers under US investment law. So I'm not quite sure if I can speak to that. So there are some qualified investors limitations, and they are much higher than the accredited, and typically don't come into play here in either Reg CF or Reg A, because it's not required.
Thank you for that. So we now reached the top of the hour, just to went a couple minutes over. So thank you everyone for your patience and understanding with that. Just want to thank Kim and Jonny again for this outstanding presentation. Don't hesitate to reach out to Kim and Jonny directly. Thanks again, and see you soon.
Thanks
Thanks,
everyone.
guys. Bye-bye.